Very good afternoon to all of you. Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's webinar on consideration of laws and regulations in an audit of financial statements. As we all are aware that this topic is very important, and in order to tackle this very important topic, we are having with us from our own Chartered Accountant fraternity, CA Anil Gupta ji. So on behalf of AASP of ICI, I extend our warm welcome to Anil Gupta ji on this platform for webinar on consideration of laws and regulation. Welcome to you, sir.
Thank you. Thank you.
I also welcome all the participants of today's webinar. So before we formally start today's webinar, it is my proud privilege to share with all of you, the brief profile of today's learned speaker, CA Anil Gupta ji. CA Anil Gupta is a chartered accountant of 1984 batch. He has also qualified post-CA course conducted by ICI, IFRS, International Financial Reporting Standard, and DISA, Diploma in System Audit. He is the central government nominee in the Central Council of the Institute of Company Secretaries of India. He has remained member of the various committees of Institute like Accounting Standard Board, Auditing and Assurance Standard Board, Public Finance and Government Accounting Committee of the Institute, Committee of Institute on Companies Bill for recommendation to the Parliament, Study Group by ICI on preparation of guidance note on CSR, Study Group by ICI on preparation of guidance note on independent directors, Committee on Internal Auditors and Internal Control of NIRC of ICI. He has authored book on practical issues on TDS, and he is also having the various contribution to the government departments. He is a visiting faculty at Income Tax Department, Ministry of Finance, Training Cell at RK Puram and Civic Center, New Delhi. He is also visiting faculty Delhi VAT Department and Punjab VAT Department. He has also taken training sessions and workshop at Service Tax Departments. He has taken training session of 62nd and 63rd batch of IRS trainings also. During the year 2005, 2004-5, 2008-9, and 2011-12, he was conferred with the award by Northern India Regional Council of Institute of Chartered Accounting for his contribution as a faculty in the various seminars and conferences. He has delivered more than 300 lectures at various seminars, conferences, workshops, various branches of Institute of Chartered Accountant of India, Institute of Company Secretaries, and various CP study circles of ICI and ICSI. He has come is a wide-ranging topics which he has covered during his conferences and seminars like Companies Act, tax appeals, transfer pricing, audit, DVAT audit, accounting standards, auditing standards, TDS, as well as the tax havens, Indian economics and inclusive growth, emerging economics, economic. Time. So without wasting much more, request C. Anil Gupta ji to please deliberate on this topic on consideration of laws and regulation in audit of financial statements. Over to you, sir, please.
Thank you, Mr. Anil Lila. I'm so thankful for the invite and for all the support that you provide me from time to time. Very good afternoon to all the friends, all the participants. First, I will begin with the presentaries. I am so thankful to CA Dr. Sanjeev Kumar Singhal, who is the chairman of Auditing and Assurance Standard Board of ICAI. I am also thankful to CA Vishal Doshi, who is the vice chairman of AASP of ICAI. It's a proud privilege to share my knowledge and the views on the consideration of laws and regulations in an audit of financial statements. You see, this is Essay 250, and let's begin the journey of this very important standards on the audit. Right. Now, the issues which I will be covering during my deliberations. So first of all, there will be the scope of this essay. Then which are the laws and what are the applicability of the laws to the various entities or the auditees. Then because the thrust of this essay is to check whether the auditee is adequately complying with the laws and regulations that are applicable to it or not. So while going through this essay, the most important part is what is non-compliance. So we will discuss it during the deliberation. Then the responsibility of the management with respect to SA 250. Actually, what is desired from the management? Then comes the responsibility of the auditor, because SAs are applicable to the auditors. It's there in the Companies Act itself that the auditor has to take care of all the SAs and have to comply with all the SAs. So with respect to this SA 250, what are the responsibility of the auditor? That also we will discuss. Then this is the most important, which I feel is this red flags. See, how will you come to know that there is non-compliance? What is desired from you as an auditor? So the requirement from the auditor is to report whether there is any non-compliance or not. But the very pertinent question is, how will you come to know? Which are the laws? How will you come to know that whether any non-compliance is there or not? What are the alarming signals? Because it won't be that you will be given a file to study. These are the various regulations which are applicable to us, and you can go through this file. It's not like that. It's not that easy. So we have compiled a list of the red flags which lead you in finding out the audit observations relating to the 250. Then this new concept of no CLOR, we will be discussing it. And a few case studies also we have brought for you from NAFRA itself. So let's begin the journey of this 250. Very frankly, this 250, this deals with the auditor's responsibility to consider the laws and regulations when performing an audit of financial statements. So what are the laws which will be applicable to the auditee? That remains to be seen, and that is the scope of this very essay. Okay. Now, these laws and regulations to which an entry is subjected to constitute the legal and regulatory framework. Now, what are the laws which are applicable to a particular client? How will you come to know about it? So, there are few guidelines which have been referred to in the essay itself. They have divided into two parts. The first part is there are some entities which operate in heavily regulated industries. And the two very interesting examples have been given. One is the banking industry, other is the chemical companies industry. So there the laws are, but the regulations are too much. So you, when you are auditing a banking company, let's say, so while auditing a banking company, you have to take care of the various notifications, various acts which are applicable to the banking companies and the banks. Similarly, it is the similar example can be taken of the chemical companies also. Then there are other type of laws which are general laws, and these general laws are related to the operating aspects of a business, such like the occupational safety, the health, or we can take few examples. One is the house tax, or maybe the shop and establishment act. So these are such acts which are applicable to all type of entities. Now question arises, what is non-compliance? So non-compliance is an act of omission. Something has been omitted with respect to a law, or some mistake has been performed by an entity or the management, either intentionally or unintentionally. And what are those acts? Those acts are contrary to the requirement of the law. If it is there, if the omission is there or the contrary performance is there, then that is called non-compliance. Such acts include transaction entered into by or in the name of the entity. So a entity can enter into on its own someone can sign on its behalf, or it can be in the name of the person who is acting on behalf of the company, right? So, but this third point is very important, that the personal conduct or misconduct of the management or employee, that doesn't come under the regulation. Let me give you very simple two examples. Suppose the manager is going on the road, an accident takes place. So accident takes place, the law will apply. But that law is not supposed to be, we are looking for in this particular 250. Or there is a dispute between the director and his tenant, or maybe his landlord where he is residing. So that dispute is none of our business, and it has nothing to do with this SA 250. That's why they have very clearly mentioned that non-compliance does not include personal misconduct. Then non-compliance with other laws and regulations may result. Now, what is the effect of the laws and regulations? The effect is there can be fines, there can be litigations, there can be costs of which we need to provide for in the financial statements. So when we will come to the reporting part of this SA 250, there we will go through the requirements with respect to the reporting, with respect to the disclosures, with respect to the accounting. So we'll come to it. But while studying the non-compliance, we must understand the consequences and the results of those non-compliances. Now, responsibility of the management. It's the duty of the management to ensure that the entity's operations are conducted in accordance with the provisions of laws. So to study the law, to comply with the law, this is the duty of the management. Auditor has nothing to do with it. Auditor has to check whether the management has complied with or not. But which are the laws which are applicable, management has to see to it. The various compliances, management has to take care of it. Then determine the reported amount, and if there are any disclosures which are required under various laws in the financial statements, so this duty of the management to see to it whether those disclosures have been properly made or not. Now, policies and procedures which the management must follow while complying with the various rules and regulations. So some examples we have brought for you. Prevention and detection of non-compliance with laws and regulations. So first of all is monitoring the legal requirements. Let me give you a very simple example. There is a restaurant. So there is a restaurant, and a restaurant needs various type of licenses. Those licenses can be liquor license. Those licenses can be fire license. Those licenses can be food license. Now, an auditor is not required to check each and every to come. He should know what are the various regulations which a restaurant has to follow. Let me read a list for you: health trade license, food license, phonographic performance license, shop registration license, ISO license, fire safety license, environment clearance license, bar license. So these are the various licenses that a restaurant, whenever a restaurant has to be opened. So management has to take care of whether the requirements of the various mandatory requirements, whether the management has checked with some expert or not, and whether management is complying with the same or not. So the basic onus is on the management. Ensuring that operating procedures are designed. So designing the procedures. So while designing the procedures, management must take care of all the laws that they have to follow. So while laying down the procedures and the internal controls, management must inbuild the requirements of the law also, apart from other internal control requirements. Instituting and operating appropriate system of internal control. This I just mentioned, that both of these, second and third, go hand in hand and go together. Then developing, publicizing, and following a code of conduct. So management must announce that these are the various laws which an entity has to follow, an entity has to comply. So they draw a code of conduct. And that code of conduct has to be followed by the employees. So rightly mentioned in this slide is that the proper training of that code of conduct and the procedure and the policies, whether there is a proper training procedure in the company or not. So now if we see this particular point from the point of management and from the point of view of auditors. So if the management is having a proper training schedule, a proper training module, and the training takes after a fixed period, let's say quarterly or at least twice a year, then there are few chances of lapses in such type of activity. So if the training module is there, training mechanism is there, internal control with respect to the compliance of the regulation is there, then the auditor is also can be comfortable that this is a company which believes in compliances. There is a compliance culture in this company. So all these issues that we have discussed, if the management is following it, so that gives comfort to the auditor also. Monitoring compliance. So various laws which the management is has announced the procedures for it, is carrying the training for it. Now, whether the monitoring is there or not, it's not merely that you have to train. You have to monitor also that the training that has been given to the employee, whether that employee, whatever actions that employee is taking, whether those actions are being monitored by the higher authorities or not, and whether there is a set procedure for the same or not. Then engaging the legal advisors, as I just discussed one slide back, that which laws have to be followed. It's not necessary that management will be knowing about each and every law. It's not necessarily. It's not necessary that the auditor will be knowing each and every law, or which are the laws which an entity might be required to follow. So the answer is, or the rescue is, that management has taken advice from some legal expert or not. If the management has taken advice from legal expert, it will come to know these are the various laws. So engaging a legal advisor is also part of legal monitoring procedure. Then appropriate responsibilities can be assigned, and generally managements generally do assign such responsibilities. Internal audit function is one of them. Then audit committee, various look after is being done by the audit committee members. Various reports are being submitted to them. Then board of directors. There are wherever the audit committees are not required as per the Companies Act, then management generally assign some of the responsibilities to a team of directors. Let's assume there are 6 directors. Then they can assign to 2 directors that you will be taking care of the compliances of the law. Then compliance functions are also can be assigned. Now comes the responsibility of the auditor. Once the systems are there, once the training module is there, once the procedures are there, once the monitoring mechanism is there, experts are being consulted, then comes the audit part. Now, what the auditor is supposed to do, what is the responsibility of the auditor? So the responsibility of the auditor is to assist this particular essay. As we when we began this presentation, so the first slide was the scope. So this particular essay deals with, or the essay has been designed in such a manner, it assists the auditor in identifying the material misstatement of the financial statements, but material misstatements relating to the non-compliance of regulations. Material misstatements, identifying those misstatements, identifying those errors, identifying those non-compliances, and then their presentation in the financial statement. Due to non-compliances, if there is any material misstatement, right? Now, this next, the issue is very important, that preventing the non-compliance or getting the law implemented, these two are not the responsibility of the auditors. So we must distinct between what is do's of the auditor and what are the don'ts of the auditor. So these are don'ts. We are not supposed to prevent the non-compliances. Yes, we can make suggestions. Yes, we can give, even being a statutory auditor, we can give a non-compliance report to the management. So while giving the non-compliance report, we can give our suggestions also, which is absolutely welcome. But prevention is not the duty of the auditor. Similarly, auditors are not supposed to detect the non-compliances with all the laws and regulations. We will come to it. There are two types of laws, direct laws and indirect laws. So what are the duties of an auditor with respect to this non-compliances? We'll come to it. So these are two different categories. So first category is called direct. So company law requirements, taxation requirements, labor law requirements. These are the direct effect on the disclosure in the financial statements. Even see, when we will come to the CARO part of this presentation, we know that in the CARO there are various provisions or various requirements under the CARO which desires from the auditor to give his comments whether the particular sections have been duly complied or not. So similar in the tax audit also, we are supposed to give the compliances of various income tax sections, and under the labor laws also, disputed dues, undisputed dues, all these are there in the CARO. So these have the direct effect, and then the auditor has to take care of while checking these particular laws, the compliances of them. Then some may not be having the direct effect, but yes, they do have. So there are certain compliances which may be fundamental to the operating aspect of the business. So as I gave you the example of a restaurant, so those are the various licenses. So if we come back to the same example again and compare here, so company law, tax and labor laws, naturally chartered accountant auditor will be taking care of. But the various licenses which are required, so here the auditor will ask the management whether they have taken advice of some expert, and what are the licenses that have been suggested by the expert, and whether the management has obtained those licenses or not. That's one part of it. Second part is various reports that have to be submitted under the while complying with those licenses and the conditions of those licenses. So all these are indirect and have to be taken care of by the management, and the auditor has to check whether those have been duly considered while carrying the audit or not. So you see, this is a very important point. If the non-compliance is there, so how do we come to know that which audit or which entity that we are auditing? So which entity is risk prone, or there is risk in the extent of risk is very high in certain cases? How we come to know about it? So apart from other red signals, the very prominent red signal is if there are penalty proceedings under against a management, and that is prevalent. The management is getting notice against each and every law, whichever law they have to comply with. So this means there is absence of compliance culture in that entity. And when there is absence of compliance culture, it will definitely affect the going concern of the business, the continuity of the business. So you see, this SA 250 is not merely confined to the non-compliance part of it or the effect of non-compliance. The effect of non-compliance extends beyond the regulations and affects the going concern of the business. So we have to take care of whether the compliance culture is there or not. So compliance with the regulatory solvency requirements, that's also part of indirect. Then compliance with environmental regulations. Nowadays, when the ESG concept is floating throughout the world, and ESG has become part of financial reporting. So compliance with environmental regulation has also become a pertinent part of the reporting. So this is also indirect part of the regulations. So there these known regulations, there can be material effect, there can be immaterial effect, that will be come to when we will enter the slides with respect to reporting. Now you see these two paragraphs are very important. As I just referred to, there are two type of laws, one which has direct bearing on a company and one which has indirect bearing on a company. Now, which has direct bearing on the company, the requirement from the auditor is different in that. You see in the first paragraph, if you read the bold words, obtain sufficient appropriate audit evidence. So your audit documentation file should have proper audit evidence of the direct laws that are affecting the entity. If to take an example, uh, income tax. So income tax site, if you have visited the income tax site, and while visiting the income tax site, you have gone through whether any demand is outstanding there. Let's take this example only, right? If some demand is outstanding there, then you have to generate evidence. Number one, the printout of the of that site, and printout of the demand appearing on that particular the income tax site. Then second issue that will arise simultaneously, whether some communication has been done by the management with the income tax department, whether some protest has been lodged with the income tax department, whether income tax department has responded to it, then how we have responded back, the management has responded back. So all these correspondence, which is the important part of that correspondence, where the conclusion has arrived. So that evidence, that communication copy you must keep with you, so that tomorrow some question is when asked from you, then you can very well explain that we do visited the site, this was within our domain, and we studied all the papers, and the final concluding part was this particular paper, where it was clearly mentioned that the outstanding demand is absolutely wrong, and we accept the request of the management. So that particular letter will come to your rescue, provided you are having it in your document, in your audit evidence file, right? Then there are indirect effects, as I just explained in the earlier slides. So when there are indirect effects, now whether you want to keep the audit evidence or not, it will depend on the particular situation also, but you need not keep each and every evidence. But yes, of course, in your audit program, whether you have suitably provided for checking certain this type of indirect law compliances, whether the audit procedure has been whether it has been inbuilt in the audit procedure or not, whether it is there in the audit program or not, whether it is there in the audit checklist or not. If these are there, then yes, you can very well explain that these were the checks we were carried. This is how we trained our audit team, and this is how we carried the checking of the non-compliances. So requirement are absolutely different when it is direct laws, and when the laws which are not directly affecting the company, the requirements are different. Let me make one another thing very clear. Direct law and indirect law doesn't mean direct tax and indirect tax. See, we are used to direct and indirect from that point of view also. So it has nothing to do with that particular concept of direct tax and indirect tax. Direct laws which are affected directly the company, indirect laws which are have generally which is applicable to that particular industry, and which are specifically applicable to that particular entity. So those are called the indirect laws. So auditor must have the understanding of the various laws. Now, the understanding means, first of all, every chartered accountant, every auditor is having a existing understanding of an entity. During our studies, or during our general studies, during reading the newspapers, during reading the articles, during attending the various seminars, conferences. So general understanding develop. So that is there. So that is one part of the source of understanding. Second part is update your understanding. So not merely having general understanding won't help you in conducting the audit in a right manner. So update the understanding, and while updating the understanding, you have to you may have to have readings. You see, recently the PMLA has come, so you have to have the reading of various sections which will be becoming applicable to chartered accountants. So updating the understanding of the laws is an important part of this essay, or complying with this essay 250. Inquiring from the management as to other laws or regulations that may be expected to have a fundamental effect. So not merely having an understanding, inquiring from the management which are the laws applicable to it, right? Then inquiring from the management concerning the entity's policies and procedures. So various policies and procedures we just discussed when we were going through the slides relating to the responsibility of the management. So we have to ask the questions from the management, whether they are having any procedures, whether they have consulted any expert, whether they are having any training module, and then how they give the trainings, and how they carry the monitoring part of. So all these questions have to be there in the audit questionnaire. So that will prove that due judgment, or the auditor has performed his duties in a right and a desired manner. I mean, see the same thing, the inquiring from the management regarding the identifying, evaluating, and accounting for litigation claims. So it's not merely the compliance of the regulations. See, while complying, there may be that some notice has been issued on the entity. If some notice has been issued on the entity, and the entity has protested, the management has protested for that notice, then that leads to litigation. That leads to litigation. So keeping the records of the litigation is also part of the audit. So it's not merely that you have to check the compliances. It's not merely that you have to check that compliance culture is there or not. It's not merely that what is the status of the non-compliance in a company, but litigation, and what is the status of the litigation, and what are the chances, what are the merits of litigation going in favor of the management. All these have to be seen while carrying the audit. Okay. Now, evaluation by auditor of the effect of non-compliance on financial statement. Now, what are the potential financial consequences of non-compliance with laws and regulations on the financial statements? For example, the imposition of fines, penalties, damages, threat of expropriation of assets, enforced discontinuation of operation, litigation. These are the consequences, and not merely consequences. These consequences have financial effect. So the auditor has to quantify these financial consequences, and then to check whether proper disclosures have been made, whether proper accounting has been done, and then the reporting part of it comes. So all three, the accounting, the disclosures, the reporting, all these three will be there once the financial consequences the auditor is able to make out, and auditor is able to get the report with respect to the financial consequences. Now, whether the potential financial consequences require disclosure, that depends on the materiality and the extent of the non-compliance. Whether the potential financial consequences are so serious as to call into question the fair presentation, so that depends. What is the extent, as I just discussed, the materiality part of it. It will depend on it whether the presentation is fair or not. If the auditor concludes, now it comes to the reporting part of it. If the auditor concludes that the non-compliance has a material effect on the financial statements and has not been adequately reflected in the CUC, and let's stop here for a while. See, adequately reflecting in the financial statement, as is there in the second line, that is the duty of the management. So the auditor has to see whether adequate reflection is there or not. Now, in this particular case that we are discussing, we are assuming, just for assumption's sake, that adequate disclosure is not there, the reflection is not proper. Now, what will happen? Then the auditor shall, in accordance with SA 705 to SA 708, express a qualified or adverse opinion on the financial statement. So the main report, auditor will have to cover the issues in the main report, how, under which head, whether emphasis of matter or whether by qualifying, whether by modifying or by adverse opinion, that depends on the extent of the non-compliance. This is another example where the auditor has been precluded by the management from obtaining the sufficient appropriate audit evidence. So management is not cooperating. Management is not providing the desired evidences, or management is not providing the answers to the various questions or the questionnaire released by the auditor. So this is a very interesting example. So in the audit documentation file, whether the auditor is having that questionnaire, then auditor is having the proof that the questionnaire was sent to the management, email copies there, then some letter has been issued, then the copy of that letter, receiving of that letter. Not merely that, whether discussion with respect to that questionnaire was carried with the staff. When the discussion was carried, what were the replies of the staff, whether you have duly inculcated those replies in your audit observations. If all is there, then you have every right to disclaim the opinion. So it will be called a disclaimer report. So sufficient audit evidence is not there. The auditor is not satisfied with respect to the audit evidence, or audit evidence has not been provided by the management. So your report will depend on the type of situation which is there vis-a-vis the management. This is also a very important part. If the auditor has identified or suspects non-compliance, right? Because when you are carrying the audit, you will come to, you will reach this conclusion whether some regulations have not been complied or there is suspicion, right? The auditor shall determine whether the auditor has a responsibility to report the identified. Now, there is no set rule whether the report should be sent to the concerned authorities or not. There is no set rule. It will depend on the extent of the damage that may be caused by the non-compliance. So if the auditor feels it has got absolutely within his right to write to the regulatory authorities that there is non-compliance and these are the consequences of the non-compliance. Or on the contrary, another issue can be done if the situation so desire, that the auditor can write to the management also that there are serious lapses with respect to compliances. These are the observations, of our audit team of the non-compliances, and there is prevalent mistakes with respect to compliances, and the number of notices that the management is receiving it, that those notices are really on a higher side. So it's better the management reports it to the authorities, to the regulators. So first letter can be written to the management also. If management suo moto acts on itself, then that will make the jobs easier for the auditor. If it doesn't, then yes, of course, the auditor has every right to write to the, or to apprise the concerned authorities about the non-compliances in that particular audit entity. Now, as I discussed in the beginning, that there are certain red flags of non-compliances. Red flag means how will you come to know whether non-compliance is there or not. What are your sources? So let's have a glance on those sources. Number one, investigations by regulatory organizations and government departments, or payment of fines or penalties. So if the penalty account is there while carrying the ledger scrutiny, whether the penalty account is there. Once the penalty account is there, that's a good eye opener for you. And if you can search in the accounting software itself whether any payment or fines have been paid, so you will get a list of it. If they have made any, given any penalties or fines, then you will come to know, because once the fine and accounting entry is there, that the penalty has been paid. Okay, so the first question should be why this penalty was levied. They will answer you. Then the second question should be, or the series of questions can be, show us the notice that you have received, show us your reply, show us the further queries raised by the department. So notices, communication with the authorities, communication with the legal councils, orders from various departments, court judgments, all these are there. These all are the red flags for an auditor. Even communication with the legal counsel is also a red flag. So we must take care of that. Scrutiny of professional fees. This is the second head in the ledger scrutiny. Professional fee account is there, ledger account is there. So if while going through the major amounts, the 1 lakh rupees, 2 lakh rupees, 5 lakh rupees, 10 lakh rupees fees has been paid to a particular consultant, then you must check on a sample basis the not merely the payment part of it. What you have to check is the professional bill of that expert. From the bill, you will come to know why he has raised the bill, what narration he has mentioned on the bill. Then you can ask them to show you the various mails, correspondence that has taken with that has taken place with that expert. So professional fees, legal charges, late fees, all these are red flags. Examination of various statutory and legal compliances portal. I just gave you an example of income tax site. Let's visit Traces site. In the Traces site, you come to know that there is TDS demand outstanding. So why? Naturally, the question will be why. So when the question will be why, then they will answer you. They will say, we have accepted this or we have protested. So accordingly, the accounting will change. Accordingly, the reporting will change. If you visit the GST site, you will come to know GST reconciliations are there. All these are the red flags for you. Income tax site, MCA site, ESI, PF. So we need to visit these sites nowadays as compared to the earlier years when there were not these were not on online. So we have to check the each and every file. So many a times the clients used to show one file and used to hide the other file. But now it's not like that. User ID, password, you need not have with yourself, but yes, you can request them to open the portal, which they cannot say no to you. And once the portal is there, you can visit all the icons there and you can come to know the whole X-ray you can do of that particular site. This is one example we have taken. If there is demand on traces for non-deposit of tax or TDS, income tax portal or GS portal, then what are the options available? Auditor to check whether protest has been lodged or not, as I just mentioned. If the protest has been lodged and there are merits in the case, and the management has given you, let's say, given you some legal opinion that this is the notice we have received, this is how we have protested, and these are the reasons we believe that on merits it will be decided in our favor, then you can comfortably can be shown by the management as contingent liability. But if the protest has not been lodged, then either it has to be shown as provision or it has to be shown as payable. When it has to be shown as provision, if there is uncertainty with respect to the amount of the demand. That 50,000 demand has been raised. We are saying yes, demand is correct, but amount is not correct. In our opinion, it should be 30,000. In the management, in the department's opinion, it should be 50,000. Then we will create a provision for 30,000. But if in the same case, the demand has been raised for 50,000, and we have agreed, we means management. So the management has agreed that 50,000 demand, yes, it is correct demand. There was mistake in our returns. We admit it, we will pay. Then that 50,000 will become payable. That will not be provision. So very frankly, we have drifted for a moment to AS 29, which deals with contingent liabilities, provisions, and payables. So I have tried to bring the three limbs of AS 29 vis-a-vis this particular example. So this example can be applied to all the portals very well. Other red flags are ESI, EF registration if mandatory for the entity. Now we must know that whether registration has been taken by the management or not. So number of employees are there on the roll. If the number of employees are there on the roll, you will come to know whether those are more than 10, more than 20. So accordingly, ESIPF, which act is applicable. So you can ask whether you have obtained any registration under the ESIPF or not. So if they have not obtained the registration, then yes, of course, there is every reason the management must mention it or disclose it in the notes to accounts. So if once the management discloses in the notes to accounts, then depending on the situation and what is the type of what are the impact or the materiality factor has to be taken. So accordingly, you can handle it in the audit report also. If the management has not shown in the on notes to accounts, then accordingly you will take refuge of 7067 and other essays while reporting on the non-disclosure part of it. So ESIPF you have to take care, not merely the outstanding demand of it. You have to take care of whether returns have properly been filed, whether registration is required, whether obtained or not. Similarly, gratuity and bonus. So the Payment of Gratuity Act, Payment of Bonus Act, this also becomes applicable, and you have to compute with respect to gratuity, the actuarial valuation has been done or not, and with respect to bonus, whatever is the amount of bonus that is applicable to that particular entity, whether they have made the desired provisions and whether they have made the desired provisions with the desired amount. It's not merely that they have made the provision. The amount is correct or not. So that also has to be taken care of. So that's also a red flag. Then check the master data of MC on the website of MCA, whether company is active, compliant, dormant, what is the status of the company. Once you check the master data, see, master data has not mere to be checked for finding dormant or not dormant. Master data should be checked for checking the list of directors, checking the list of shareholders also, because many times the shareholders, the changes take place in the mid period itself, and whether the same has been reflected or not. So this helps you in carrying the audit. Payment for unspecified services or loans and advances to the consultants. Now, this is very interesting red flag, and this is alarming red flag. See, payment has been made to the consultant, but the bill is very non-speaking. You are not able to make out from the bill of that consultant what services he has provided. So that leads to suspicion. Or loans and advances have been given to consultant. This means, can we ask a question? Is it the fees in the grab of loan? Because once the fees, we nomenclate it as a fees, we show it under the fees accounting head, then the bill has to be there. And once we show it just as advance, then bill may or may not be there. So this particular is very important red flag. Loans and advances to government employees or contractors. If they are huge sums, if there are unreasonable loans and advances to government employees or contractors, then again, you have every right to ask the questions. Unreasonable or non-sticky loans and advances, and there is no litigation. This is also very interesting. So advances have been given, and there is no movement in the advance account. So why the advance has been given? So that also will lead to that there is some issue with respect to compliance of there can be some issues, right? So these are the red flags. Diversion of business funds by way of unreasonable loans and advances to related parties or employees. So if the diversion is there, then what is the reason for it? So these reasons can lead you to non. It's not necessary that the answer will be that there is non-compliance. No, it's not necessary. But red flag means that's an alarming signal for it. So alarming signals help you in performing the audit in an effective manner. Sales commission or agent fees that appear excessive in relation to those ordinarily paid by the entity or in its industry or to the services actually received. So excessive commissions paid, again, it's a red flag and you need to ask questions about it. Purchasing at prices significantly above or below the market price. What is the reason for it? The reasons will lead you to a series of questions, and even answers will be very interesting for you. So you will be able to dig out of it. What are the reasons for it? These are the good leads for a good audit. Unusual payments in cash, purchase in the form of cashier's checks payable to bearer or transfer to number of bank accounts. All these are various red flags which can help you in finding the status of the compliances and non-compliances. Unusual payments toward legal and retainership fees, we have discussed more or less. Unusual transactions with companies registered in tax havens. So this is again you see, and this has very much to do with the PMLA that is being discussed nowadays. Even Caro, there is a questionnaire on Caro, and recent amendments in the notifications that have been just released in last 10 days. So this is what they are asking for: tax haven payments transactions. Payments for goods or services made other than to the country from which the goods or services originated. So why there is diversion? If there is diversion, then of course that's a red flag. So you see that makes your audit very interesting as well as very effective, and you will be able to get the good audit observations out of it. Payments without proper exchange control documentation. So foreign exchange payment is involved and the proper documents are not there, then again the same, it is a red flag. Existence of an information system which fails, whether by design or by accident, to provide an adequate audit trail or sufficient audit evidence. So whatever the audit transactions, what are the transactions are there? The very fundamental principle is, if the management is not leaving the audit trail or the sufficient evidences are not there, then auditor has every reason to ask the questions and to report it. Once the auditor reports it, then yes, of course, the auditor gets scot-free. Unauthorized transactions or improperly recorded transactions. Naturally, this is all leading to some fishy issues or suspected transactions in the company. So once the more the suspected transactions, more these red flags, so more are the chances of that company going into red. This means there is mismanagement. That mismanagement can be intentional. That mismanagement can be out of negligence. That mismanagement can be unintentional. I am not specifying the words whether it's intentional or not, but what I am trying to bring home is that if any of these red flags are there, or if there are more than 5 or 7 or 8 red flags out of this list of red flags, then the auditor, there is an alarm bell for auditor, and there is something wrong with this entity. Adverse media comment. This is also very important. And in case of large entities, large businesses, the media comments should also be taken care of. Examples of some of the regulations, which are the regulations that the auditor need to comply. These are some examples. These are not exhaustive list of the regulations. See, section 129 of the Companies Act. It clearly lays down that the accounting standards have to be followed as per section 133, which have been notified under 133. And these are the exceptions: insurance company, banking company, electricity company. To these three, this section doesn't apply, this particular subsection, right? And so while complying with the, while carrying the audit of insurance, banking, or electricity company, the auditor has to take care of the specific laws applicable to these three type of companies. And with respect to other, the requirement of 129 has to be complied with. If you are conducting the audit of an NBFC, then absolutely the whole of the scene changes. The design of the audit changes, the audit requirements changes, the evidences changes, the understanding, the requirement of the understanding of the auditor changes. You see, there are NBFC systematically important non-deposit taking company and deposit taking company directions. There are number of directions which becomes applicable to it. NBFC. It depends under which particular category your audit is falling. Then non-deposit taking company, Reserve Bank directions 2016. Otherwise, systematically important. Second one is non-systematically important. These are technical terms. Our topic is not NBFC today. I am not deliberating on the systematically and the non-systematically part of it. Then core investment company, CIC. These regulations prescribe for registration requirements, whether registrations are there or not. Naturally, if the company is engaged in financing and investments, one has to see. Then capital requirements, income recognition, income from investment, accounting standard compliances, accounting of investments, asset classification. All these are the various requirements under the NBFC regulations, which are desired by SA 250. Provisioning requirements, disclosure in the balance sheet, accounting year, schedule to the balance sheet, loans against owned shares, securities of shares, and concentration of credit or investment, etc. The lending has been done to a particular group only, then the reporting requirements change. Similarly, the investments that have been made by the reporting entity, then investments, if are concentrated to a particular group, then the reporting changes. So all these are the various regulations which are required under NBFC. Then the various duties have been cast on the auditor. So there are NBFC auditors report directions that also auditor has to take care of. Then MSME Act of 2006. There are various provisions which the auditor has to take care of. Section 15, liability of buyer to make payment. Section 16, date from which and the rate at which interest is payable. Section 17, recovery of amount due. Section 22, requirement to specify unpaid amount. Section 23, interest not to be allowed as deduction from income. This we are already taking care of in the income tax also, tax audit. Then section 24, overriding effect of section 1523. So all these are the various requirements of MSME. And yes, this is particularly a fit case. This is indirect law. So as we were discussing in the earlier slides, there are certain direct regulations, there are certain indirect regulations. So this is an example of indirect regulation. CARO. Now, PMLA, we discussed 2-3 times what are the requirements of the PLA, whether any proceedings have been initiated or pending against the company for holding any Benami property under the Benami Transactions Provision Act. So we have to report here. Then regular whether the company is regular in depositing the undisputed statutory dues. You see, there are two types of one is undisputed, other is disputed. So there has to be some reason for not depositing the undisputed statutory dues, and this is also a red flag. Then, if dispute is pending, then the status and its reporting and the various requirements that has to be reflected in the by reporting on the CARO. Then whether any under the Income Tax Act, whether any amount has been surrendered by a company, whether any additional additional income has been disclosed by a company. If yes, then its status and various requirements under this particular clause has to be reported by the auditor. Whether money is raised by way of IPO, whether it has been properly compliance has been done or not, and whether the funds have been properly used or not, all this has to be reported. This we have already discussed, the non-banking financial companies regulations. Yes, the fraud reporting. If there is fraud, then 143.12 becomes applicable. Not merely that, Rule 13 becomes applicable. So it has to, the auditor has to take care of all these sections and the rules. Then yes, there will be, yes, here. Yes, under the CARO also in clause 11, whether fraud by the company, fraud on the company, all you have to report. And if any report has been already given under 84, then that has also to be given here. And whistleblower complaints are there, that has also to be considered. So these are the regulation. This is just a part of regulation, this CARO. But CARO leads you to various acts and various regulatory frameworks. So CARO is very helpful in seeing the non-compliances and the compliances part of a entity. Then the resignation of the auditor. This is also to be reported and requirement of the Companies Act, right? Then apart from resignations, yes, let's come to NOCLAR. Non-compliances of laws and regulations. So under the Code of Ethics of the Institute, these particular amendments have been made. And it speaks of absolutely the same type of provisions which are there in SA 250. Only extra statutory requirement has increased while adding it in the Code of Ethics. You will just glance through it very fast, because I will like to discuss with you the case studies. So basically, it started from the international ethical standards, and there it sets out a first of its kind framework to guide PAs in what actions to take in the public interest when they become aware of potential illegal act known as non-compliance of laws and regulations committed by client or employer. So the standard positions the accounting profession to play a greater role in the global fight against NOCLAR, such as fraud, money laundering, and corruption. That's why non-compliances reporting, the thrust is being given on to combat the frauds, to combat the money laundering, to combat the corruption. This is the first time accountants have been permitted to set aside the duty of confidentiality under the Code of Ethics to disclose NOCLAR to appropriate public authorities in such circumstances. You see, confidentiality stops us from sharing it with someone, but yes, you can share it with the authorities, and you can share it with the other public places, public institutions also. It depends where it is desired. So I am skipping this part. This is all is there with respect to NOCLAR, and one has to be very careful while complying with the compliances part of it, to comply with the principles of integrity by alerting the management. All this we have discussed. Let's go through it. The examples of laws and regulation which this section addresses include as deal with fraud, corruption, and bribery, money laundering, terrorist financing, and proceeds of crime, securities marketing trades, banking and other financial products and services, data protection, tax and pension liabilities and payments, environmental protection, public health and safety. So more or less, we have covered, these are the various type of examples of the regulations that the auditor has to consider while carrying the audit duties. Now, what are the duties, professional accountant actions that are desired? So disclosure part is there, withdrawing from the management and the professional relationship where permitted by law regulation if the one is not getting the response, and in spite of reporting, and then disclaimer report is there. These are the various, it's applicable from 1st October 2022 and applicable to listed companies or having net worth of 250 crore rupees or more. Right? It's not applicable to all, but SA 250 is applicable to all. So no CLAR will also become virtually applicable down the line also. Now let's come to the case studies. This is basically by NAFRA, National Financial Reporting Authority. They have conducted the checking of the audit report and the various financial statements of Jayaprakash Associates Limited. It's audit quality report. And what were the facts of the case? It's very single fact I have brought in front of you. There were number of facts which were available, and this is fit case of lapse by the auditor, not reporting on the non-compliance. So, how far the repercussions for an auditor can be if the disclosures are not proper, if the reporting by the auditor is not proper. This is a fifth case. The Competition Commission of India, via its order dated 31st August 2016 on the Jayaprakash Associates Limited, held various cement manufacturers liable for alleged contravention of certain provisions of the Competition Act during financial year 9-10, 10-11, and imposed a penalty of 1,300 crores on the company. Okay, this is one part of it. So penalty of 1,300 crore was levied by the Competition Commission of India. What happened? This is the disclosure the company has made. The company has disclosed the above liability as contingent in the standalone financial statement. Now you will be, I think you will be able to appreciate that just 3 or 4 slides back, around 10 slides back, we discussed AS29. So when to be shown as contingent liability, when to be shown as payable, when to be shown as provision. So it's not merely the regulatory part of it, the reporting part of it is also equally important. So here the company has made the above penalty raised as a contingent liability. This means the company feels that it has the necessary merits and it has the evidences to establish that they will be able to win this appeal, and this penalty will not, the company will be able to get this penalty cancelled. That is what the contingent liability is. Okay, what happened? Observations by NAFRA. On questioning by NAFRA, the auditor provided a copy of management representation letter, which simply reiterates the matter presented in note 32D to the standalone financial statements without providing the details of the current status of the case and the probability of winning the case. So what the auditor was having as rescue for showing that particular penalty as contingent liability, it was having only MRL. So if the MRL is not backed or substantiated with the sufficient audit evidences, you see, they have raised a pertinent issue in NAFRA. Then let's just read the last line. The probability of winning the case. So the auditor must ask, what are the probability of you winning the case? It's not merely that the management has stated that we will win the case and auditor should be happy and the auditor's responsibility is over. No, not at all. That is not the requirement. The requirement is that the auditor must have the issue the necessary questionnaire and get the answers to it. And even the amount is so much, it's more than 1,000 crore rupees. Further, there are no records of verification of the legal opinion in order to cross-verify the management contentions with respect to this matter. So both of the issues were missing. Neither there was any legal backing of the contention made by the management, nor the auditor has raised any issues, nor the auditor has raised any question. What the NAFRA will do? They have taken the necessary action against the auditor. So one has to be very careful. In the absence of any legal opinion in such a crucial matter, the engagement team has merely relied upon the management's representation and gone ahead with the issuing an emphasis of matter in this matter. Providing an emphasis of matter on this matter is not in accordance with the requirements of para 6 of SA 706 dealing with the audit report, as sufficient appropriate audit evidence is not obtained. So these were the strictures passed by the NAFRA against auditors. In light of above facts and findings, the strictures were passed by NAFRA against audit. This is the first case study. Let's go to case number 2. Again of the Jayaprakash Associates. What are the facts? Based on the response of the audit firm to the NAFRA's questionnaire dated 30th June, NAFRA had conveyed the following conclusions. What were they? NAFRA observed that the audit firm has, in compliance to clause 313 of company auditor's report in action to independent auditor's report, reported that according to, yes, okay, it's relating to the related party transactions. According to information explanation given to us, the auditor is writing it. Basically, this which is within the inverted commas, this is the auditor has reported in the canon. So I'm reading it. According to the information explanation given to us and based on our examination of the records, the company's transactions with the related parties are in compliance with section 177 and 188. So auditor is reporting and is satisfied that the requirement of section 177 and 188 of the Companies Act have been duly complied with. And details of such transactions have been disclosed in the standalone Ind AS financial statements as required by the applicable accounting standards. So auditor has very categorically agreed with the disclosures made by the management. And secondly, auditor has very clearly mentioned that proper disclosures have been made by the management. Okay. And all the necessary documents with respect to the related parties, the auditor has checked. That's why the auditor has mentioned in the CARO that 177, 188 has been duly complied with. Okay, now let's come to what the audit NAFRA observed. Observations by NAFRA. However, NAFRA concluded that the audit firm had failed to obtain sufficient or appropriate evidence to appropriately report under clause 313 of the CARO. With regard to the approval of related party transactions, NAFRA noted that that was arranged very haphazardly. The working paper file was arranged very haphazardly, contained multiple duplicate copies of only 7 minutes of audit committee meetings where the company had taken prior approvals for related party transactions. Out of these 7 approvals, only 1 approval that represented just 1% of RPT with subsidiaries was available in the audit files. Now you see, minutes were there of the audit committee of the 7 minutes. But out of these 7 approvals, the necessary evidences with respect to related party transactions were available only up to 1% of the related party transactions. Now, getting the evidences of 1% of RPT, how can the auditor say that all the compliances with respect to the various related parties have been duly complied with? Not merely, just see it. Further, on perusal of note number 48 of the standalone financial statement for 1780, NAFRA noted that sale of plot categorized under other items worth rupees 600 CR is presented under transaction with subsidiaries but audit firm failed to obtain the sufficient appropriate audit evidence. Now, this is fit case. 600 CR is the appropriate audit evidence, or is the related party transaction, and no mention of it. And secondly, the auditor has not cared to check the papers and the compliances with respect to related party transactions. Just go ahead. The audit firm did not obtain the list of all the related parties that documented the nature of the related party transactions. Now, what to do? Not merely that. Also, there was no relevant evidence to support the audit firm's assertion that they have checked MBP1 of all the directors of the company. Now, you see, with respect to related party transactions, from where the whole story starts under the Companies Act. MBP1 has to be taken. From there, you will come to know which are the related parties, where the directors are interested. So once the director makes a declaration in MBP1, then the auditor will come to know that this director is interested in this particular company because the director has disclosed. Now, let's say director is interested in, or he is director in another company, let's say ABCN company. So if there are any transactions on the purchases or sales with respect to that ABCN company, then that will be related party. So if the basic document MBP1 is missing, if the list of the related party is not available in the audit evidence, audit documentation file of the auditor, then how can the auditor report under the CARO that 177, 188 has been complied with? So these two are fit example of not merely the non-compliances, but the inadequate reporting, the wrong reporting, the deficiency in the audit documentation file, the missing of the appropriate audit evidence. So all this have led NAFRA to pass very harsh strictures against the statutory auditors. So NAFRA concluded that the audit firm had failed to discuss with the management any observations related to RPTs as required by paragraph 6. So therefore, the audit firm was found to have failed to obtain sufficient information, which is necessary for expression of an opinion, or its exceptions are sufficiently material to negate the expression of an opinion, not carried out the audit according to standards on auditing and guidance note on CARO, provided a certificate of compliance with the provisions of the Companies Act 2013 pertaining to RPTs as required under class 313 of CARO 2016 without due diligence and without obtaining sufficient appropriate audit evidence. So we come to the end of this presentation, and this is what broadly we discussed. Your questions are welcome. We discussed in the beginning why of this SA 250, why this is needed, and what is required under this SA 250. Then which are the laws and regulations that cause the indirect laws those are there, those have to be taken care of. Then it's the non-compliance part which is more important, and we discussed at length the non-compliance part of the various regulations and what are the management's duties and responsibilities in the compliance, not non-compliance. In the compliance, what are the duties of the management, how they have to lay down the code of conduct, they have to give the training, they have to monitor. Then the responsibility of the auditor. So auditor has to see the compliance culture, the various internal control procedures, and then the proper disclosures have been made in the financial statements. And with respect to the direct laws, they have to have the audit evidence. With respect to the indirect laws, whether the audit procedures have been properly followed or not. Then red flags we discussed at length, various type of ledger accounts and the notices and the sites and the nature and the type of transaction and the payments that all lead to red flags. And then NOCLAR also we discussed, that's a new concept which has been brought in the code of ethics. And case studies of Jayaprakash Associates The first was relating to the penalties and the not proper disclosure, the showing it under the contingent liabilities, and that was a wrong disclosure. And secondly, the total, I must say, the total chaos or chaotic disclosures with respect to the related party transaction in the CARO. So this all I have to say about this particular presentation. I'm so thankful to all the friends for the patient hearing, and I'm thankful to AASP, the chairman, vice chairman, Saab, Mr. Sanjeev Singhal and Vishal Doshi ji, and over to Anil Dilaj.
Thank you so much, sir. Thank you so much for detailed deliberation on the topic. Sir, I have received certain queries of the members. So if you permit, can I raise those queries, sir?
Sure, sir. Sure. Please do it.
So first question is, sir, there are many laws and regulations applicable to the organization. But the question is how far the compliance of those laws should be verified and reported in the audit report for violations? Or should it be limited only to Companies Act 2013 or Income Tax Act 1961? And what about the other labor laws, economic laws, and other laws?
I think I have covered it at length. Still, to give a summary of it, you see, company law, taxes, and labor laws that we have to take care of. There is no doubt about it. As I mentioned in my presentation also, that the online websites are there. All the companies are having their user ID and password, so one must visit the sites. Secondly, the auditor must get a list of the various laws which the company has complied or which are applicable to the company. So once the laws are, the auditor knows about the laws, then asking the question becomes easier. This is the first part of your question. Second part is how far we have to check. So our checking with respect to the direct laws, that see, the reporting is there. So once you are doing the tax audit, then the sections are there. So the guidelines of the checking the sections is absolutely in the guidance notes. I am not dealing with that part of it. Company law, the guidance note is there. CARO, the guidance note is there. So you have to comply with the guidance note. With respect to other laws, you have to check only the cursory checking of it, whether the registration is there or not, and due returns are being filed or not, and whether there are any notices against the company or not. Yes, Mr. Dilal.
Yes. Yes, sir. So what impact will be there in views of recent PMLA notification, and what disclosures would be necessary there?
You see, very frankly, I also mentioned twice or thrice during my deliberation. PMLA, the recent amendments that have been brought on 3rd May and onwards, this is applicable to chartered accountants. SA is applicable to auditors, and auditors have not been covered PMLA, and rightly not have been covered. So as far as the audit part is concerned, we need not deal with it. That particular amendment, that the questionnaire, that has been inquired, that question is relating to the notification of PMLA. So that notification is not applicable to auditor. Second part of it, rather the question that has been not asked, I am answering it, that there is requirement of PMLA under CARO. So that one has to see as auditor. And that is not, that has nothing to do with the notification that was brought on 3rd May. That was brought in the act itself last year itself.
Yes, sir. Yes. So one query is for related to the one of the case law. One member is asking, the client has not received export proceeds within 6 months of the date of export, or not paid the foreign exporter within 180 days of the import of goods into India. But neither the AD banker nor RBI had issued any notice or intimation for the last so many years, and the statutory auditor also did not comment on the same for the last so many years. But suddenly, can the statutory audit in a later year wake up and demand the client to insert into notes of accounts regarding the same in the absence of any notice from AD banker or RBI?
It's a very interesting question. First of all, I must congratulate my professional colleague who has raised this question. See, there are three parts to it. One part is that more than 6 months have crossed. Second part is proper disclosures have not been made. Third part is the proper reporting has not been done by the previous auditors. So it's these three are lapses. There's no doubt about it. So now let's come to the present, current status. Current status is today's auditor. So I am assuming that the gentleman who's asking me this question, professional colleague, he is the statutory auditor, or maybe his colleague is a statutory auditor. Then in that case, the reporting must be done. Otherwise, once the notices will be issued to the auditor, if it's a immaterial sum, I can't make any comment. But it's a material sum, then definitely it's going to create problem. So my humble submission is that make proper disclosure by way of notes to accounts. And if any provision has to be created or any reversal has to be done, because they must have shown in the previous years, the same amount must have been shown as export sales. So the legal provisions have to be taken care of reversing that export sales. So that has to be taken care of, and the proper disclosure must be made and reporting must be done.
Yes. Sir, in case of export, if the amount is not realized, then export incentives and GST refund are to be given back to the government authorities. If a private limited company do not refund, then whether it is to be reported in the audit report?
Yes, it has to be.
It has to be reported.
First of all, it should be reflected in the notes to accounts. And if it's a proper disclosure and the management has done all the necessary action, management is taken, then emphasis of matter will be sufficient. Yes, sir.
Some guidelines regarding to the system for SA 250, that all laws applicable are required to be maintained at a place with the system of compliance, training and reason for non-compliance, which are to be handed over to the auditor for consideration.
No, you will have to repeat, because I think there was some...
Just a gist, member is asking just a gist once again, whether a system is there in SA 250 that all laws applicable are required to be maintained at one place with the system of compliance, training and reasons for non-compliance, which are to be handed over to the auditor for consideration.
I think it's a very generic question. And
yes.
In my presentation, this presentation is applicable. This presentation is available to the participants also. No?
Yes.
They can access it anytime.
Yes, sir.
Okay. So my yes, no. Okay. So my request is that the red flag is there, that particular slide, so that the auditor, the gentleman who is asking me that question, my friend, so he can take care of he can get the answer in the red flags. And secondly, with respect to the various laws applicable, you see, there cannot be a specific answer to it. Every auditee is bound to comply with the laws which are applicable to the industry to which that particular entity belongs. So there cannot be a standard answer to it. But as I requested, that I gave an example of restaurant, that in case of a restaurant, there are certain licenses which are applicable. So I as an auditor cannot know, not possible. So in that case, I will ask the management to provide me a certificate from an expert who is a legal expert in the restaurant field. These are the various licenses required, and the compliances, the registrations that the client has obtained, those registrations are sufficient, and that's a sufficient audit evidence with me. I need not proceed ahead, just apart from taking a copy of that particular certificate issued by a legal expert.
Sir, then one member is asking, where CARO is not applicable, then any non-compliance of CARO needs to be reported in main audit report?
You see, it's a very good question. I must appreciate my friend. CARO is not applicable, but CARO is a checklist. There are various questions. So what I am presuming, that some of the questions that have been asked in the CARO the answers have become applicable to this particular friend of mine. So if there are some adverse comments with respect to the Caro questions, then in spite of the fact that Caro is not applicable, in the main report, my friend can cover the non-compliances and the adversities of the various issues which he wants to raise. So in my opinion, he can very well cover it in the main report. Yes, there can be another clue to him that if those particular non-compliances or adversities can be reported in the notes to accounts, then it will make the life easier for the auditor. You see, notes to accounts come to our rescue if the management accepts certain thing. Let me give you a very simple example. In case of GST, if the compliance, if the reconciliation is not there, the GST as per the profit and loss account and GST as per the appearing on the site, those are not matching, or as per the returns not matching. But management is saying that we are in the process of reconciliation and the mistakes or the unreconciled amount will not be material, and management is willing to write it in the notes to accounts, and auditor is satisfied, yes, that the management is definitely doing its job. Due to certain reasons it couldn't, and rest of the compliances and the reconciliations are on the dot, then reporting in the notes to accounts will be sufficient. Just as a precaution, emphasis of matter can be given in the main report.
Yes, yes, sir. So last question. So post applicability of NOCLAR, can you kindly redefine the scope of knowledge of applicable laws to be possessed by the auditor and reporting obligation on matters directly or indirectly affecting the financial statements?
Anilji, I just mentioned in my question answer session also, and in my presentation also, that
Yes, again, they have raised this.
it's okay, okay, no issue, no issues, no issues. There cannot be a standard for it, standard reply
Yes.
for it. It depends, because you see the regulations, there are more than 1,000 regulations in the country. So regulations differ from entity to entity, industry to industry, business to business, size to size. So
Yes,
there cannot be a set norm for it. So I gave a standard document. The standard document is obtain the list of laws applicable to your auditee from some expert. Once you obtain, then just check those files, because they must be having soft copy or hard copy of the various compliances that they are conducting in those indirect laws, the various laws which are applicable to that particular entity. So if those are there, then part of it you can keep in your audit evidence file. That will be sufficient.
fine, sir. Fine, sir. So one last question again pop up, sir. Member is asking, sir, please put your light and clarify whether determining non-compliance, whether auditor has to act as a tax officer or as an auditor, which is concerned with clear cases of non-compliance, not requiring any interpretation of law or sit in the judgment.
Good. As I explained in the presentation, that getting the compliances done is not the duty of the auditor. Not at all. Our auditor, our duty is just to see whether compliance culture is there, number one. If the non-compliances are there, then the impact of the non-compliances on the financial statement. I gave 3-4 examples, quantification of it. If it cannot be quantified, there are maybe few issues where it cannot be quantified, because let's say the company is not filing its return regularly. Now,
Yes.
there cannot be any demand against the company. Maybe in future penalties or interest can be raised. So, so a simple note in the notes to accounts that company is irregular in filing its returns, but company is filing its returns, and those current returns are in matching with the books. Then I think it's not a very serious issue. Yes, non-compliance culture is there, and if it's prevalent, then I alarmed that if the prevalence of the non-compliance is there, then that company can go into red at any time.
Yes. So thank you so much, sir. We have come to an end. Thank you so much for wonderful deliberation. And on behalf of Auditing and Assurance Standard Board of ICI, we once again we extend heartiest thanks towards you for sparing your valuable time and enlighten all of us on various intricacies of SA250 and all the questions raised by the members.
Thanks.
Thank you so
Thanks,
much, sir.
Anil
Thank you so
Lalji.
much.
And please
Thank you, sir.
convey my thanks to Chairman Sahib and Vice Chairman Sahib.
Sure, sir. Thank you, sir. Thank you, sir.
Thank you. Thank you, participants. Thanks a lot. Thank you.
Thank you, sir.